So, as you know, we recently wrote a book. If you're on our YouTube channel, you see a copy of the book, Next Gen Dollars and Cents. As you know, it covers a range of topics, primarily intended to give you the tools and strategies that you need. And the next generation, whether that's the next generation who are in their 50s or the next generation who are in their 20s, same concept applies. The kinds of things that you need to know to make good financial decisions. What's interesting is that two articles came across my desk just this week that underscores the importance of why such a resource is important. Why education about your financial choices is so crucial. And to that end, here we go, shameless plug, why you really need to take advantage of our special offer that we're running from now until the end of the year, December 31, to request your absolutely free copy, hardcover version, okay, of our book, Next Gen Dollars and Cents. To do that, simply go to our website, nelsonfinancialplanning.com. You'll see a little banner thing there. Click on the Request My Book, and you'll immediately have a little pop-up where you put your name, your address, and how many copies you would like. So if you've got maybe 2 or 3 kids or 3 or 4 grandkids, and you think that this would be a useful resource, we certainly think it is a useful resource, but we might be biased because we wrote the thing. But it is yours for absolutely no charge at all. If you wait, then you're going to be forced to go on Amazon, Barnes & Noble, and the like, and pay those guys $14.99. Instead, you can call us, and we will mail you out an absolutely complimentary copy. My name is Joel Garris, Certified Financial Planner at Nelson Financial Planning. You're listening to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of the top 25 financial planning podcasts on the World Wide Web. So, what were those 2 articles that came across my desk that really sort of almost set up as a natural segue into the conversation that we've been having about our new book over the course of the past couple of weeks? So, number one, it was a study by the Millikan Institute that concluded that 43% of Americans are not financially literate, but they think they are. Let me say that one again. So nearly half of Americans believe that they're financially literate when they really aren't. The lack of financial literacy in America today is shocking. When you got nearly half of the population believing that it is that they're financially literate, but they really aren't, that's a real problem. And I guess the scary part of it is, and you may say, oh, well, that's just an individual basis. It doesn't, sure, there's a bunch of people that maybe not make the best financial decisions out there. But when you start making poor financial choices on an individual basis, it actually percolates up to much, much higher levels, because those decisions that you're making individually, if we collectively make them as a country, well, then guess what? Before we know it, our bad financial choices can, in fact, lead to issues at the national level. So let's just think about it this way. Let's say someone's never been taught about things like loan agreements or compound interest or return on investment. And without that knowledge, you may make a decision to ultimately do something that has a big cost to perhaps obtain something that doesn't have as much value as you think it might. And so if you don't understand the concepts of what a loan agreement is, or what interest rate is, or what compound interest rate is, and ultimately what opportunity cost is, all of those financial terms and what they really mean, well, then stop and think about where we may be seeing that in real life sort of play out that is a national issue. I mean, I don't know about you, but what immediately springs to mind is the student debt loan crisis, right? I mean, I think a lot of people that signed those student loans didn't necessarily understand what a loan agreement was, certainly didn't understand what compound interest is. Oh, if the interest applies from the time I signed the loan, because that's how a loan works, it's not like you don't get to avoid that interest, and then that gets compounded on top of the amount I borrow, well, then my goodness, I'm going to graduate owing 40, 50% more potentially than what I actually borrowed in year 1 or year 2 of going to school. So if you don't think individual financial choices don't really matter, or maybe that was a double negative. I think I might have said that one wrong. Individuals' financial choices certainly matter. And it matters more than you think. And it matters more on a national level. And it matters more that it's going to impact you, those other financial choices, those other financial decisions that people make, right? I mean, think of this. Biden administration so far has forgiven $127 billion of student loans for a total of 3.6 million borrowers. Somewhere, somebody's paying that cost. And so that cost then gets pushed on to the rest of us. Now, I don't want to get down the student loan conversation and all that stuff. We've certainly done that on a prior radio show. I think one particularly back in August of 2021 stands out, where we got into whole personal responsibility and all those kinds of things. We're not going to go down that path today. If you want to listen to the prior show, I think it was August 17th, actually, of 2021. But financial decisions, or our inability as a country to make good financial choices, where we've got a country where half of the people think that they're financially literate, but according to the Millikan Institute, they're really not. That's a problem. And certainly, I hope you would agree with me that a few of the folks in government might maybe stand a lesson. Maybe that's what we'll do. I'm going to send a free copy of Next Gen Dollars and Cents to every member of Congress. They probably need it. Because let's face it, those individual decisions, the notion of making poor financial choices, that percolates up. And that creates a country that, as we look at it today, right, not in the best of financial shape. High debt, high government spending, high consumer debt, low savings rate. I mean, that's a bad combination. So I guess I would say, if you want to make a difference in the world or in this country, start by making good financial choices and encourage those around you to make good financial choices, because it all percolates up. And there's a very real, easy example that is capturing front page of the newspaper today that is that very definition. If folks had understood loan agreements, compound interest, all of those kinds of things, perhaps they would have made different decisions, right? Rather than just blindly signing on to all these student loans. So that is study number 1 that came across my desk. Millikan Institute conclusion that 43% of Americans are not financially literate, but think they are. There's another one that also came across my desk, and we're going to get to that, but we got to take a break here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Story number 2 that came across my desk just this past week that underscores the importance of financial literacy and why people need to be making better decisions when it comes to their financial choices. Story number 2, this one is an annual one, so I've seen it before, but it was just recently done by the folks at Morningstar. It is Morningstar's annual Mind the Gap study. So every year, Morningstar runs this study that looks at the performance of funds just in general, and then further looks at the performance of individual investors who own those funds. And in this particular study, they always look at it on a 10-year rolling basis. So this is from like December 31, 2022, go back 10 years from there. And so it's looking at that period of time. And so what the study concluded is that the average fund gained 7.7% per year over the 10 years ended 12/31/22, while the average dollar invested, so the average investor in these same mutual funds, ETFs, earned about 6% annually. So let me say that again. The funds all did 7.7, but the average person that owned the funds only did 6. That's a problem. That's a 1.7% difference per year over 10 years. So that makes about a 20% difference in the amount of money that you have at the end of a 10-year period of time. And I'm going to read this more. This Morningstar study further found that investors struggled to time cash flows into and out of investments, which costs them dearly, right? I mean, if you're missing out on 1.7% per year every year for 10 years, it adds up significantly. That's one of the biggest reasons why, it was last week, maybe the week before, that we were talking a lot about cost and why cost is material as well, right? If your cost is high, then you're getting less of a return. So you really need to be cognizant of how much it is that something is costing you. Furthermore, the Morningstar study concluded that as a result of when investors bought and sold funds, i.e. timing, investors missed out on about 20% of their fund investments' average net return, according to the study's author, Jeffrey Tack, who is the chief ratings officer for Morningstar Research. That's not good. It gets even worse, though, when you're talking about sector funds or alternative investment funds. Sector funds have an even larger performance deficit, an even larger gap. Average investor in those funds achieved a return about 6.4%. Meanwhile, the average sector fund got about 10.8, a gap at 4.4, nearly triple the gap in performance of what the average investor saw versus what the fund did during that same period of time. You understand what the analysis in the study is looking at, right? It's looking at, okay, if I'm an investor and I've got $1 in the fund, how good was the return that investor had, and then comparing it to just simply owning the fund straight on through that 10-year period of time. Well, that's the performance gap that we're talking about. So if it's 1.7% across the board on kind of the normal cross-section of funds and ETFs, added up over a 10-year period of time, that's about a 20% difference. If you start getting into some of these more exotic sector funds or alternative funds, the gap gets even bigger. In this case, in sector funds, the folks at Morningstar concluded that it was a 4.4% gap per year. That's a 50% difference in what you'll have over a 10-year period of time. And we get it. Sector funds are really cool to have, right? Imagine having like an AI fund, right? An artificial intelligence fund. That would be really kind of fascinating and neat. And, oh, man, I got to have that. But the problem is that those sector funds have a tendency to be more volatile. And then that volatility, yep, you guessed it, gets people's attention. And so consequently, people wind up reacting to said volatility and shift their money around right when they really shouldn't. That shifting of money around leads to the performance gap that this Morningstar study is concluding. Similarly, there's also a big gap on alternative investments. This one's become somewhat popular. It sounds great. Don't you want to own something different? Alternative. Doesn't that sound like it might be something that's different than, what maybe you've got out there? The problem is that also has a pretty significant performance gap. The more it was interesting as you read the study from Morningstar, the performance gap or what investors are missing out on got wider the more sort of, I guess, exotic or the more marketing driven, if you will, that their choice of investments was. So sector funds, much bigger gap. Alternative funds, much bigger gap as well. So beware, as the study is entitled, Mind the Gap the reality is that your reactions can and will cost you significantly. Remember, money is such an emotional topic. Folks, that's why the very first chapter of our book talks all about emotions, talks all about the things that can impact you on a regular basis. So we're going to talk a little bit more about that in this section, of the program. But let's take a moment and just welcome in our listening audience. You're listening to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Central Florida's longest running radio program, also one of the top 25 financial planning podcasts on the World Wide Web. My name is Joel Garris, certified financial planner, and of course, a certified financial fiduciary with Nelson Financial Planning, where we got a team of great folks, all of whom happen to be certified financial fiduciaries as well, that stand ready, willing, and able to help you improve your life with a cost-effective and successful financial plan. So that's one of the reasons why Chapter 1 of the book talks about emotions, because if you're going to talk about anything about investing or anything about financial choices, then you can't ignore the fact that we are human beings, and human behavior makes an impact on how we ultimately make those choices. Think back to the things that we've been talking about so far on the program. The Millikan study that said that 43% of Americans think they're financially literate, but really aren't. The Morningstar annual performance assessment, the Mind the Gap between what the performance is on investments versus what the average investor got, that is a significant 20% difference in terms of what you could have had over the course of a 10-year period of time. And if you're going into some of this sector or alternative funds, the gap is even greater. The shortfall that people have on a day in and day out basis is so dramatic and adds up to so much over the course of a 10-year period of time. That's why the book, Chapter 1, starts with the conversation about human emotions and how that impacts you. And it goes further into talking about some of the cognitive biases that are out there, talking about the role of negativity. Folks, when you lose $1,000, it creates an emotional reaction that studies have concluded triggers a 3 times greater reaction than if you gain $1,000. Stop and think about that. It's a 3x more powerful emotional reaction on a negative versus a positive, even if they're exactly the same number. That's a lot of what causes people to make poor timing decisions, poor investment decisions when it comes to your money. And that first chapter in the book, filled with a lot of different cognitive and behavioral biases that ultimately really do cause us to go astray. Things like anchoring, which is the concept of, I'm going to, go with this notion because this is what seems correct now, and then I don't ever move off of that. Bandwagon effect, right? I mean, who hasn't been on a bandwagon at some point one way or the other? The problem is that if it's in the investment world, by the time everybody's talking about it, it's way too late to have to do that. So again, if you're interested in your free copy of our complimentary book between now and December 31, it's only complimentary till the end of the year, reach out to us at the office at nelsonfinancialplanning.com or give us a call, 407-629-6477. We've been talking a little bit about emotions and how much that impacts us in terms of the decision that we make. And stop and think about the example we were talking about before the break. If you lose $1,000, you're going to have an emotional impact that is 3 times greater than if you were to gain $1,000. Now, they're the same amount, but one produces a much greater emotional reaction. Those emotional reactions, unfortunately, undermine the investment decisions and the financial choices that we make on a regular basis. That creates a problem, not just at the individual level, but we would submit that permeates to the national level as well, particularly if you're looking at the country's finances and see, okay, big overspending and high consumer debt and low savings rate, that creates a problem, right? It's all about making good choices and making good choices on an individual level and encouraging those around you to make good choices as well. That's why we thought it as important as it was to sit down and write our book, Next Gen Dollars and Cents, to help put some of those concepts all in one place, whether it's taxes, whether it's retirement, whether it's mortgages, whether it's estate planning. There's a chapter on each of those topics in the book. Again, it's yours for free between now and December 31, simply by calling the office at 407-629-6477 or going to our website, nelsonfinancialplanning.com. So again, can't emphasize the emotional aspect of investing, of money, of financial choices, but it also permeates into retirement, as you might well imagine. Here's a study that came up. I had a lot of studies coming across my desk this past week. So here's number 3 of the studies that came across my desk this past week. This is courtesy of the Retirement Coaches Association. And we're just going to read it. And then we're going to kind of chew on it and break it down. So here's what it is. Here's what the conclusion was. While most Americans will cite inadequate savings as a concern for their future retirement, a recent survey, courtesy of the folks at Retirement Coaches Association, found that for recent retirees currently struggling in their retirement, other issues like a loss of identity or a lack of routine or a lack of friends or a lack of community or watching too much TV, all ranked ahead in terms of the survey of retirees, all ranked ahead of financial difficulties in causing problems. Stop and think about that. Loss of identity was cited by the majority of new retirees as creating the biggest struggle in retirement. 53% cited loss of identity. Meanwhile, only 10% cited financial difficulties. Folks, the emotional aspect of everything that we do when it comes to our money is real. And those things will impact us and affect us. And that's part of why we do the show, right? Because every week there's always some new headline. Every week there's always something to talk about. And it boils down to making sure that we have good perspective, that we have an understanding of what it is that is going on out there in the world at large. So welcome on in to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're one of Central Florida's longest running radio programs, also a top 25 financial planning podcast. So make sure that when you find us on your favorite podcast platform, that you subscribe to us. And then that way you'll get notified as to when we upload new content. If you have any trouble finding us on your favorite podcast channel or on YouTube, simply go to our website, nelsonfinancialplanning.com, and you'll see a bunch of icons. Those icons, click on them. You'll get immediately connected over to the channel on those particular platforms. While there, make sure you also click the link to request your complimentary copy of our new book, Next Gen Dollars and Cents. Certainly a timely tool, particularly as we think about some of those studies that we have talked about earlier in the program, underscoring sort of the emotional component to it. So listen to all those things that retirees cited in this most recent survey that ranked ahead of financial difficulties: loss of identity, lack of routine, lack of friends, lack of community, watching too much TV. And think about, if you're thinking about retiring, or maybe you are retired, what do any of those apply to you? Have any of those impacted you? Or do you feel like you're out of routine? Do you feel like you're disconnected? Successful retirement, we would submit, is much more than just about money. I mean, certainly need to have money to retire, but what people find is that when they retire, there's other issues that come in that you might not necessarily have thought about. And so that's one of the biggest issues when we're talking to people about retiring or thinking about retiring or planning to or we're doing some planning in terms of income planning for retirement, one of the very first questions that we ask, if you've ever been in to visit, then I always phrase it as, well, what are you going to do with the rest of your life? And that's the question that kind of needs to get answered. Beyond just where am I going to get my income from in retirement, it's the question about, what are you going to do? I mean, if you're retiring in your 60s, I mean, let's face it, actuarially, the odds are pretty good that you're going to have a 25 or 30 year retirement. Well, that's almost going to be as long as what you spent working. When you're working, there's certainly a strong routine to that ultimately prevails. But when you're retired, less of the routine. There's also a loss of identity because you're not, we're not working. People aren't looking to you for guidance. All of those kinds of things. So that's certainly an important question. It's one of the very first things that we sort of ask people when we're talking about retirement is, what are you going to do? What are you going to do the rest of your life? How do you really think about or plan for that across the board? So some interesting, I guess, conversations of how all of the emotional part rolls together, particularly when we think about the survey of the things that bother recent retirees. Not so much about financial decisions, because hopefully if you're retiring, you've taken the time to kind of map things out. So you should be okay with that. But then when you get into retirement, it's things like loss of identity, lack of friends, lack of a routine. So before you jump into retirement, we would encourage you to not just think about, okay, well, where am I going to get my income from? And that's super important. Don't get us wrong. And that's what we spend time with people every day at the office to do that. But we also ask the other question, which is the more emotional question, which has to deal with, what are you going to do? What is the game plan? And those are the kinds of things that we think it's just as important to know and understand, because what the surveys say is that more and more people, when they retire, don't necessarily struggle about the money part. They struggle more with the emotional part, the routine, the friendships, the loss of identity, all of those kinds of things. So certainly some important things to be thinking about as we think about retirement. What is your game plan? What are you going to do when you retire? And what does that really look like? Those are some important questions that we would certainly encourage folks to think about and reflect on as they approach retirement. So let's not also forget a lot of headlines this past week in terms of the economic numbers, the meeting of the Federal Reserve, and all of the data that has come out of late that show a particular direction of the economy that I think bears conversation on the program as well. So we're going to tackle all of that in the next segment. So stay with us through this break here on Dollars and Cents. This, of course, is Joel Garris of Nelson Financial Planning. If you're interested in a copy of our new book, Next Gen Dollars and Cents. We've been talking a little bit about it on the program and comparing it to some of those studies that came across our desks that show that Americans really aren't making good financial choices. They need to be armed with a much greater level of education. Then just reach out to us at nelsonfinancialplanning.com and request your absolutely free copy of your book this week, and particularly since we're only offering this until the end of the year. So make sure you reach out and grab your copy in time for the holidays. Anyway, we're going to take a break and continue after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So an interesting week economically, that is for sure. You had the GDP number come out for the third quarter at a surprisingly strong 4.9% economic growth. Meanwhile, the inflation reading at like 3.7%, that also came out points to an interesting turn of events in the economy, that you still have strong growth, predominantly propelled by consumer spending, and an inflation rate that is lowering. So against that backdrop of data, the Federal Reserve met this past week and on Wednesday announced that they would not be raising rates at their particular meeting that they had just held. So why is that interesting? Because when you think about how much the Federal Reserve raised rates within a very short 12-month period of time, it was a pretty dramatic course of action. And we're just seeing and continue to see the impact of these higher rates throughout different portions of the economy. Because the thing that people often forget is when the Federal Reserve raises rates, it usually takes 6 to 9 months before that actually gets into the system. It's not like you can you raise the rates and then it's an immediate impact in the economic system. It takes some time. So as we sit here today, first week of November, then you really haven't seen some of the interest rate cuts that happen in the first half of the year really make their way into the economy. And the ones that have, certainly you're starting to see the impact, right? 8% mortgage rates, car loans well into the double digits, credit cards well above 20% in terms of the interest rate cost. All of that then becomes an issue when we think about people's ability to handle their finances. And so what that then sets up is that sets up a tougher economic environment. But here's the other part of that. As you see these higher rates, as you see these sort of the tougher part of the economic implications of these higher rates, you also get closer to the point where the Federal Reserve is going to start to cut rates. Because remember, this whole notion of interest rates works like a cycle, just like the economic cycle. There are periods of expansion, periods of contraction. Similarly, with the Federal Reserve, there are periods of time where the interest rates are increasing and then periods of time where the interest rates are decreasing. Perhaps you've heard the expression, don't fight the Fed. That's the notion that when interest rates are increasing, well, then the Fed is tightening money supply. It's tightening your ability to borrow money. And ultimately, then that is intended to slow down the economy or to stamp out inflation. That certainly has been the case over the course of the past 18 months as the Fed has been on this very aggressive increasing of the interest rates. But as with each Fed cycle, you get to the point where, okay, well, we don't want to go too far and things have slowed down a little bit. And so consequently, we're going to start to go the other way and cut rates. And here's the thing that I think most people don't appreciate. When we talk about where interest rates are going, the Federal Reserve in its own model suggests that by the end of next year, so 12 months from now, that interest rates will in fact be anywhere from 50 to 1 full percentage point lower than where they are today. That's the Fed's own projections. And so now you have a market, this relates back now to the market and what the market did this past week, trying to kind of figure out where that turning point is. Because what history tells us is that when you get to the part of the cycle, the rate cycle that has to deal with lower interest rates and easing interest rates, well, then guess what? That's good for the economy. You usually see corporate earnings expanding and all of those kinds of things that help to push up the market. And that's sort of what we saw play out to a certain extent this past week, because the conclusion or the announcement on Wednesday that, hey, you know, we're not going to raise rates. We're going to leave the door open that we could later on. But at the end of the day, I don't think really anybody kind of bought that, which is why you saw the market moving up as well as it did, because at the end of the day, lower interest rates are usually expansionary for the economy. So that's what this past week was all about. Got some interesting economic data, but then also the Federal Reserve meeting as well. And the important thing is that even the Federal Reserve own projection says that interest rates are going to be anywhere from 0.5 to 1 full percentage point less than where they are right now. So that tells you that at some point you're going to get to the period of time where the Federal Reserve is going to be start starting to cut rates. And I think that's what we saw play out in the market, where, trying to anticipate that being, I guess, sooner rather than later. Time, of course, will tell on that, but certainly an interesting week in terms of the economic headlines and in terms of the market. One of the many things that I think can throw people off, because it underscores how quickly the market can move in a short period of time. And I think that leads to some of the things that we've been talking about on the program as well, particularly that annual study by the folks at Morningstar, the Mind the Gap study that looks at that difference in performance that individuals experience when they own a particular investment versus what that investment actually did over the course of a 10-year period of time. That gap winds up being 1.7% per year, according to the most recently completed Morningstar study. And when you start to add that up over a 10-year period of time, that adds up to a pretty significant amount of money, 20% less than what you should have had you just owned the investment and not decided, I'm going to get in, I'm going to get out, I'm going to try and move money here, there, and everywhere else. And then furthermore, when you think about that Morningstar study, it really underscores the risk of why we as a firm don't do a whole lot of sector funds and don't do anything on the alternative side, because all that stuff sounds really good, but it comes with a heightened level of volatility that makes it even more difficult as an investor to really save and invest money on a regular basis, because anytime you have a heightened level of volatility, you get more emotional. And that's the key topic, I guess, that we've been talking about at length on the program this week, is that there is such an emotional component to money, and such an emotional component when it comes to things like retirement, when it comes to things like making financial choices, that I think sometimes we just sort of gloss over that, but that's a large part of what ultimately drives us. As we mentioned, that's how we started out the book right from the very beginning. Chapter 1, important to talk about that, because that sort of ripples behind every financial choice and financial decision that we make, whether it's the role of negativity, or whether it's any of the many cognitive biases that we have as humans that have to deal with anchoring our decisions on particular topics, or wanting to stay with the status quo, or jumping on a bandwagon. All of that described in great detail right at the very beginning of the book, because this emotional component underscores and lurks behind every decision that we make when it comes to our money. So make sure you request your free copy of the book, Next Gen Dollars and Cents, on our website, nelsonfinancialplanning.com. We hope you've enjoyed the show. As always, if you've got anything that you'd like us to talk about on the program, or if you've got any comments about anything that you heard today, feel free to reach out to us as well, courtesy of the website. Again, that address, nelsonfinancialplanning.com. We hope you enjoy the rest of the day, the rest of the week. We'll be back next week, as we always are, to talk about the headlines that were. In the meantime, enjoy the day. Don't forget to set your clocks back as well here this morning. So thank you for listening to the program. This has been Dollars and Cents with Joel Garris of Nelson Financial Planning.